Welcome to our viewers. My name is Colby Smith, and I'm the U.S. Economics Editor at the Financial Times. I'm thrilled to be joined today by Fabio Natalucci, the Deputy Director of the Monetary and Capital Markets Department at the IMF, alongside Tom Piontek, who serves as a Senior Financial Analyst in the same group. We're here today to discuss Chapter 2 of the Global Financial Stability Report ahead of the annual spring meetings here in Washington, D.C. And the focus of this chapter is on non-bank financial intermediaries. These are the hedge funds, the pension funds, the insurers, to name just a few examples, who make up this space and have really become key players in the global financial system. But that centrality, combined with the fact that many of these institutions are highly levered, at times can create a toxic mix that when market liquidity dries up, that requires central banks to step in. So Fabio, let's start with you. In recent weeks, we've seen banks globally come under pressure, and some even fail outright. And the fear now that we could start to see cracks form elsewhere, especially as central banks plow forward with interest rate increases to fight inflation. So I'm curious if this is just a prelude for what's to come for the NBFI sector.
Right, so thank you for the question. So clearly financial stability risks have risen quite rapidly in the last few weeks. We have seen the failure of two banks in the US. We also seen what started as idiosyncratic events effectively at some regional smaller banks, turning and investors questioning the health of the overall banking system, not just in the US, but also in other jurisdictions, right? So we have seen the failure of the merger, if you want, but stress at one of the global systemically important institutions in Europe. Now, so there's been a forceful response by policymakers. Clearly that helps stem some of the systemic risk and anxiety. But the system, as you said, is still very fragile. We're coming out of 10 plus 15 years of very low interest rate, very low volatility, very ample liquidity. Then we move into a new regime, if you want. High inflation, more persistent than perhaps we policymakers had hoped for. And so not just the extent of increase in interest rate, but the pace at which interest rate have been increased. Those are the strains that we see in markets and financial institutions. Now, it's not the first event, if you want, right? So this is somehow, it's a typical bank run in some sense, right? We have deposit questioning the liquidity of what's on the asset side of the bank. They start run, the bank is forced to sell, and that's the typical bank run that we study in school in some sense. Of course, it was amplified by technology and social media, right? There were $40+ billion withdrawal in one day. Mm-hmm. But we have seen some of this, right? We have seen stress in the UK in October. We have seen stress in Korea. We have seen commodity trading firms during the Russian invasion of Ukraine. What all these episodes have in common is the vulnerabilities that you highlighted. So this liquidity maturity mismatch, the use of financial leverage in different corners of the system, and also the interconnectedness, right, within the non-bank financial institution sector, but also with that sector, with the banks. Now, so the fundamental question, I think, at this point in markets, is whether this is essentially cracks under the system, so the canary in the coal mine, that it's going to be a prelude to more systemic stress going forward, or this is just a painful, if you want, natural manifestation of increasing interest rate after all this year. And that's what I think what investors are looking for different different stress points in the system. So in the banking, the focus is on regionals now, and there are stress and challenges to the business model. On the liability side, the funding costs are higher. What do they have on the asset side with the shrink lending, as well as in the NBFI sector, right? We can mention a few, commercial real estate in one. And then also other sectors themselves. So all this is going to have huge implication, I think, going forward for asset allocation, asset prices, and how this vulnerability will resolve.
Absolutely, and I definitely want to dive into commercial real estate and some of those specifics. But before we get there, Tom, I'm curious, what weak spots you see. I mean, some of the flashpoints that Fabio mentioned, it seems like, you look around the global financial system and, that there's a very long list where there are potential vulnerabilities here.
Yeah. So in the chapter, we look at three main vulnerabilities in the NBFI sector. So Fabio mentioned leverage, liquidity, and interconnectedness. And on leverage, we try to describe the different forms this can take. You can think about on-balance sheet leverage, so borrowing short-term in the repo market to fund an investment. You can think about off-balance sheet derivatives-based leverage, so options, futures used to gain a bigger exposure to an asset, and then embedded leverage that comes along with structured products. And I think in the chapter, one of the key findings is that there are specific segments in the NBFI universe where, particularly hedge funds, where it looks like leverage still remains elevated. However, a key takeaway is that it is really difficult to get a comprehensive view of the complexities and the layers of leverage that can build up over time due to data gaps. And this sort of raises concerns to us about hidden leverage that can emerge in times of stress and lead to further asset price declines and spillovers. The second vulnerability is liquidity, and here we highlight two individual characteristics: liquidity mismatch risks and market liquidity that you mentioned. And for liquidity mismatch risks, we highlight investment funds in the NBFI sector that hold potentially illiquid assets. You can think about EM assets or highly speculative grade credit that also offer daily redemptions, and combined with strains in market liquidity. So asset prices more sensitive to people selling. We even noted this in the government bond market, which is usually a very liquid market. And it's this combination of liquidity mismatch risks and strains in market liquidity that we call liquidity spirals, where investment funds might be selling. This leads to further asset declines because of strained market liquidity, and this has spillovers across the system. Now, the third vulnerability is interconnectedness. You can think of this as the combination of leverage and liquidity risks leading to contagion across the system, across different dimensions among NBFIs, between NBFIs and the banking sector, and then cross-border. And in the chapter, we highlight a growing sort of interconnectedness globally among NBFIs, but then also cross-border. We've seen a pickup in interconnectedness between the banking sector and the NBFI sector. And this is particularly important for emerging markets, and thinking about how the NBFI sector is a key source of financing for emerging markets. And we highlight, again, investment funds here and show that in previous stress episodes, say the March 2020 onset of COVID, that EM bond funds particularly saw really larger outflows, asset price declines compared to other investment funds. And so this raises concerns about during times of stress where EMs will get funding. So overall, some of these interlinkages, still hard to identify with data gaps, but the idea is to hope to deepen our understanding going forward of these interlinkages.
Yeah, absolutely. I want to talk about data gaps in a bit, but before we get there, it seems like everyone's attention has turned to commercial real estate. In the aftermath of what we've seen across the banking sector, it does seem like it's been identified as the next big problem. And Fabio, I'm curious what you think is really concerning there.
Yeah, so commercial real estate, it's a point of focus now for a number of reasons. I think one, because there are some structural changes since COVID, right? So people working from home, we have seen defaults on a number of financing packages on different buildings in different cities in the US. So there are structural reasons that could challenge the fundamentals of this market. On top of that, now we're adding some of the financing stress that we're seeing, right? Particularly in the US, because both banks and non-banks play an important role. So regionals or regional banks, they are a major player in the funding of commercial real estate. So those banks account for about 70% of the overall bank lending in the US. So if there is stress in the sector, again, because of funding structure, because of profitability issues, they could retrench from lending and reduce their credit extension. But also NBFI are important players in those markets. So I think about the CMBS market, so the commercial backed securities market. There's a number of investors in the sector in the different tranches. So there would be, if the stress there, and we've seen rating agencies expecting defaults to rise, so that could hit the return on some of these investors. And then there's also the risk. And we have seen price decline there. There's been pressure for some of the names out there for withdrawal. That's been handled the way they are with limits on the withdrawal. But you can see the stress can spread. I think the concern is the overlay of the structural issue with the financing and given out spread the exposure to commercial real estate, particularly in the US, the financial sector is.
Mm-hmm. Absolutely. Now, Tom, the chapter goes into an interesting case study in Korea that alludes to some of the stress that Fabio talked about. I think this is a situation where we saw debt markets come under stress in the fall after there was some default of commercial paper issued against real estate project finance loans. Can you talk a little bit about what happened there and how that kind of relates to some of the broader themes that Fabio just mentioned about commercial real estate?
Sure. So I should say in the chapter we have 4 case studies that basically I think the goal or the role is to provide real-world examples of the vulnerabilities we discussed, leverage, liquidity, interconnectedness of these things interacting together to have spillovers broadly across the financial sector and system. And you mentioned the Korea local stress and debt markets there. This is a very interesting story because it emerged from really a constellation of factors: tighter financial conditions, an increase in bank funding demand, and then a decline in real estate prices. And as you mentioned, it was triggered initially by a default of commercial paper that was backed by real estate project financing loans. And these loans are particularly important because the NBFI sector is very active here. Insurance companies, other non-bank credit intermediaries are big providers of credit in this area. And this ultimately, as you said, spilled over to money markets, spilled over to broader credit markets, and involved intervention from the authorities to sort of stem system-wide funding stress, asset purchases, broader liquidity provision. But I think that the key takeaway is that it's this environment of tighter policy, tighter financial conditions that multiple countries are facing right now, combined with potentially pre-existing NBFI vulnerabilities that can lead to these type of stress events emerging in other areas. I think one other case study that we note in the chapter is the UK pension fund LDI event from this last fall. And I think the question we try to answer is whether or not the vulnerabilities that we saw in the UK pension system, whether or not there's evidence of this in other countries. And one of the key takeaways that we see from a sample of large pension funds, global pension funds, that their leverage has actually picked up over the last decade. And we note that leverage was a key amplifier in these LDI strategies that led to margin calls and asset price spillovers. But however, one other key takeaway is that the UK pension system did have some very unique specific characteristics to it, one being that it was pension fund portfolios at highly concentrated positions in fixed income investments, particularly longer dated bonds, and left them exposed to the sharp moves we saw in gilt yields and ultimately spillovers to the LDI. So I think the takeaway is, while there might be some characteristics in other pension funds around the world, the interaction of, say, leverage and concentrated positions or liquidity might not emerge in other scenarios.
Mm-hmm, absolutely. And Fabio, was there anything regulators could have done or should have done in some of these episodes where there were these obvious vulnerabilities, as you've mentioned? These are not things that are new, that have been flagged by regulators, even by the fund itself. So what is your kind of recommendation here to regulators?
So I think this is an important point. I think that's what we're trying, if you want the value add of the chapter, is trying to frame this vulnerability, but in terms of policies. I mean, the lesson number one obviously has to do with monitoring, right? It's important to monitor these vulnerabilities, being able to track them over time, so ongoing, timely monitoring, and that goes back to the data point. So you need to have data to do that. The issue is, like, NBFIs often are not part of the monetary policy operation framework. There are some exceptions in the US, like primary dealers or money funds or broker dealers, but generally they're not. And so how to think about access to liquidity? I think the access to liquidity should be given if there is risk of systemic contagion or to either markets or specific financial institution as systemically important, or if the sector or segment or institution are important in terms of provision of credit, liquidity, or other financial services. But there needs to be guardrail in place. I think that's the important point. So the first line of defense has to be surveillance. You need good internal risk management by the institution themselves. You need supervision, obviously. You need regulation. And regulation has to be appropriately set to the risk of the NBFI, right? You cannot apply the same principle. The one-size-fits-all approach doesn't work, right? Because as you mentioned at the beginning, you have insurance company, pension funds, hedge funds, money funds. They're very different in terms of liquidity, risk profile, investor themselves. Point number two, I think the central bank liquidity provision to NBFI should address liquidity risk, not solvency, right? Solvency should be addressed by the fiscal authority or by the resolution authority if you get to resolution. After what we call the stick and carrots approach, right? So regulation and supervision should force you to internalize liquidity risk, and then central bank can provide liquidity in case of systemic risk, but avoiding moral hazard. There's about 3 types of liquidity approach that we thought. One has to do with market-wide operation to address system-wide liquidity issue. So it has to be temporary, has to be targeted to specific institution, has to be targeted to restore market functioning, and then it has to be time-bound. Right? At some point, you need to get out of the business. The second type has to do with the lender of last resort, if it's directed at specific systemically important NBFI. In that case, it has to be done to solvent institution at penalty rates, so it has to be expensive, it has to be fully collateralized, and there has to be supervisory oversight. And then there's the issue whether they should be part of standing liquidity facility, right? And I think that answer there has to do with the legal institutional system on individual jurisdiction. In some cases, again, in the US, they are part of it. It depends on where you look at. And finally, communication, I think it's crucial here, right? You need to make clear that this is done specifically to address liquidity risk. What is the objective? What are the modalities? And how the central banks plan to get out and return to market finance.
Yeah, no, for sure. But it sounds like the problem is actually, quite a bit more basic in terms of the data gaps. And Tom, you mentioned this to start. So before we kind of get to all of these emergency measures that central banks might have to do, which could potentially lead to some moral hazard issues, which I want to get into next. But it starts with kind of knowing where the weak spots really are, and I'm just curious if you worry that where the real vulnerabilities are things that are not even yet on our radar because there's this substandard data collection or data availability with this sector.
Yeah. I should stress, and Fabio mentioned this, that really as a first line of defense, robust regulation, supervision, and surveillance is really vital. And really to do any of this, you need to have adequate, reliable, timely data. And I think, within the NBFI sector specifically, there are still meaningful gaps, even though we've had some improvement since, say, the global financial crisis in terms of gathering data more broadly about the financial system. And there's also a lot of discrepancies, I would say, across border, across country in terms of what's collected, definitions of various data variables. And so this makes it very difficult to do sort of cross-border comparisons of different sectors. I think one good sort of global example of this that cuts across all NBFIs is the global derivatives market. And again, we've had some improvement in data availability from this sector. There's derivatives trading on exchange that are now centrally cleared, that actually a lot of data is collected, but it remains highly confidential. There needs to be sort of strict data sharing agreements in place to be able to share across border. And so again, makes it really difficult to do sort of a global assessment of exposures here. There's also specific asset classes like foreign exchange or commodity markets where there's still a lot of data to be collected on counterparty risks. And then a lot of data still in derivatives markets on things that aren't centrally cleared, that are just sort of bilateral trades. That said, there are international working groups that are looking to implement continued data collection, dissemination of more reliable data to policymakers. We actually provide in the chapter a heat map by NBFI and by vulnerability of where the data gaps we think are most prevalent. But I think the sort of key takeaway, again, is still that there's still much to be done to fill data gaps, to gain a better, meaningful understanding of the risks that are potentially be building in the NBFI sector.
So it sounds like government authorities really are in a tough spot. They lack the kind of clear insight into where there's vulnerabilities, but they really do often have to react because there are broader systemic kind of issues stemming from these issues. And this goes back to, your point about moral hazard and where that comes into play. And I guess, Fabio, a second point to that, or a second question rather, is, are central banks making the system inherently more fragile by kind of stepping in as often as they do?
I mean, I think another point to emphasize here, because part addressed this question, this cross-border aspect, right? We have seen with the merger between Credit Suisse and UBS, how many authorities have been involved in some sense in that, how many have a stake in the final outcome. Because some of these institutions, and the same is true for NBFIs, they operate cross-border, right? Some of these activities are not just in the US or in Europe or even emerging market. They're just some of these entities are global entities. And so that's where I think the data gap and the supervisory, and that's why it's important that a group like the Financial Stability Board and all other international fora, they address this issue, both in terms of data, in terms of cooperation. I think the issue of moral hazard, of course, every time there's a crisis, the issue of moral hazard comes up. I think at this point, authorities have done what is needed, which is forceful action. You need to address systemic risk. confidence is at the center of the financial system, so you need to maintain confidence in the system. If there's no confidence in the system won't work, which means credit provision will come to a halt, and then it's going to have a big impact on the economy, right? There's a lot of market participants already making calculation. What will happen? We've seen tightening lending standard for banks. The NBFI sector appear to be tightening their standards too. What would mean in terms of slowing down economic activity? So that aspect, I think it's important. Now, you need to also think how to set up the infrastructure, though, if you want, like the framework, in a way that works for the next crisis, if you want, at this point. And I think what I was trying to lay out before were some of these principles. They are usually principles for lender of last resort taught for banks. And so the question is what changes and how to translate those from banks to NBFI. Some of the principles stay. I think the need for strong internal risk management, that starts with the institution themselves, with the need of every appropriate supervision, strict supervision, and regulation where it's needed. Again, there is no single answer. There are different entities. Some of them are regulated more than others. So it's clear that the regulation should be tailored to the risk and what kind of risk they pose to the institution. And then if there's a need to intervene, again, it's important to intervene, make the case of why the central banks are intervening, what are the modalities of intervention, what are the objectives, and how they plan to get out. Or whether this is time-bound, whether it's contingent. That part, to me, it's important because if you combine the two, then you can make sure that there is, in some sense, internalization of this risk, right? And then that, in case of liquidity, in this case, liquidity risk need to be internalized, and then central bank can step in to address the systemic part of the liquidity risk. Again, but not solvency. Solvency is for someone else. Solvency is for the fiscal authority, resolution authority. I think some of this principle can really transport it from the traditional 100+ years lender of last resort. The question is how to adapt to a world that is different, has different risk profile. Also, again, the technology, right? Technology, I think in case of SVB was an important driver in some sense of the acceleration and how that quickly spread. And so the question is whether the current institutional setup is set up in a way that can actually respond quickly to the speed of those runs.
Right, right. It also sounds like there needs to be a lot of global collaboration. And Tom, I'm curious kind of what your thoughts are there, because, I mean, with some of the case studies that have been mentioned, and even with the regional bank situation, you know, we're dealing with today, the thought is, okay, this is perhaps not an issue that's contained to this one institution. It's something that has global ramifications. Thinking specifically with LDI, the fear was that, you know, stress in UK government bond markets would mean stress in the US government bond markets or more broadly. So how do central banks really need to, and government authorities really need to collaborate here?
Yeah, I think Fabio mentioned some of this, but the cross-border considerations when sort of conducting these liquidity facilities provisions is very important, both from the source country that's actually providing liquidity, but also the recipient country or recipient sort of institutions that can have spillovers to other countries, particularly EMs here. We're thinking about sort of fund flows being pushed out of, from this liquidity to EMs. And we note that, this is an important source of funding for EMs, but there's sort of roles that, of course, the central bank and the source country needs to think about. And Fabio mentioned this sort of proper NBFI regulation, thinking about these investment fund flows that are in place, but also source countries that may be receiving funding as a secondary part of this liquidity provision. So in EMs, they have tools in place for FX intervention or maybe macroprudential policies to help sort of contain macro financial risks that may build up from financial flows that could not necessarily be sticky and in times of stress, flow out fast and lead to other sort of spillovers across asset prices. So there's responsibilities from the source central bank, but also the receivers of the liquidity.
Mm-hmm. For sure. Now, I just want to end with, a kind of a broader look at the macro environment here, because it seems like, with inflation still elevated, at the same time you have central banks kind of continually having to use their monetary policy tools to get, return to price stability. That's, continually creating this tension perhaps with financial stability. We saw it with the regional banks. It's likely, given both of your points, that we could see this further across the NBFI sector. So, Fabio, how do you think central banks need to navigate, the tension between these two objectives?
I think we need to start from a realization, which is, again, we had 15 years of rates at zero, close to zero, negative in some jurisdiction, we have volatility that was very compressed, subdued inflation, and a lot of liquidity out there. And that incentivized investors to go out and take exposure to duration, liquid assets, credit risk, and use financial leverage. Right? This is the big question, where is leverage now in the system? So we have highlighted in a number of global financial stability reports before how the combination of tighter financial conditions, so higher rates, tighter financial conditions, and some of this vulnerability could become a problem. And so again, here is the speed of acceleration of rates going up. Right? So this was going to be painful. I think that was obvious for a while now. The issue, again, is whether it's just a painful manifestation of removing liquidity or this is something more systemic underneath. Now, in principle, central banks have different tools to address different objectives, right? Monetary policy and financial stability, and that should allow them to continue to tighten monetary policy. Inflation is uncomfortably high. It's been way more persistent than was hoped for, and they need to bring inflation back to target. Now, if financial strain is intensified, though, and they threaten the health of the financial system amid high inflation, that trade-off may actually be more evident, may emerge. So in that case, I think communication is crucial. They need to make clear, very clear, what are the objectives, what is the reaction function, the policy function. If there is a need, they need to step in, as they did, quickly, expeditiously, to address risk to the health of the financial system. There's no price stability without financial stability. And then, if they need to do that, it's important also that they communicate that as soon as this financial stress subsides, they will go back to the business of bringing inflation back. That part of the communication is crucial so that markets do not entirely reassess the expected path of monetary policy downward.
Right, right. And something you hear often is that higher inflation or the central bank, reneging on its commitment to price stability could actually lead to bigger financial stability problems down the line. Is that something you're concerned about?
Right. So I think growth ultimately is the necessary ingredient both for financial stability, but price stability is a prerequisite for growth and financial stability. So that is the main objective. We have inflation, honestly, it's uncomfortably high. It needs to come back to target. Financial strain complicates the life of central banks. But ultimately, I think that remains the objective, conditional on not being in a world where financial stability is put under is a threat.
Yeah, great. Well, thank you both for joining. This has been a really interesting discussion, and there'll be lots more to come as the spring meetings get underway. So thank you.
Thank you.
Thank you.